Today I'm joined by Sergio Gallardo, who I recently read his article, Crypto's Incentive Misalignment Problem, and wanted to bring him on to discuss that. So why don't you first and foremost introduce yourself? Obviously, we've known each other quite a while now and met in person during the depths of the bear market in, I think, 2022 or 2023.
Yeah.
But yeah, why don't you introduce yourself before we get into the meat of the topic?
Yeah, for sure. And thank you for having me. Yeah, it's great. So I think we met, early 2023. I think we first spoke about something related to Parsec. Then we met in person in a few events. Now great that you came to Dubai. So yeah, I'm Sergio. I work at Peridon Ventures as an analyst there. Been a couple of years working in ventures. So yeah, Peridon Ventures is the crypto arm of a family office. They mainly invest in real estate. They do a bunch of other stuff. But yeah, I think it was around late 2021, they decided to start the crypto arm. So we're, small team investing mainly in early stage projects, but we do a little bit of liquid investments. We also invest in funds, but yeah, quite flexible.
And your background was doing something entirely different and then crypto on the side, right? Before you started doing this full time.
Yeah, I had been working in market research for like 5-6 years, living in London. And then during like 2020, 2021, I went down the rabbit hole through like DeFi summer, got very interested in the space, and started doing some freelance work in crypto for a couple of companies. And then at some point I ended up doing the transition to crypto in beginning 2023. So it's been a couple of years now, full-time crypto.
So as I introduced Sergio, I mentioned the article which I'd read, which was kind of the idea behind this talk was really to discuss this article that you wrote, and the title was Crypto's Incentive Misalignment Problem. Now that's a bit of a it's a lot of words, but let's first and foremost talk about where the idea came from. Like, what was it that prompted you to write this? Where did the idea come from?
Yeah. So I don't know if you remember when we met in Paris last year, we were talking about problems in the industry, kind of like lack of maybe new ideas, new use cases. And it's a topic that I enjoy thinking about it and looking at, okay, which problems we have, where's the industry going. I think something that some people often miss is like looking at the reasons why we have certain issues. Like, for example, we had the issue of like high FDB, low float tokens at launch, shady behaviors by some people. And we look into the problems, but sometimes we don't look into the reasons why those problems exist. So I've been spending like quite a lot of time recently thinking about, okay, which things are wrong? Why are these things happening? And that's where I started thinking about the incentives and the reasons why those things are happening. And I think the moment that it clicked for me was when I started comparing it to traditional venture and thinking how the incentives work in traditional venture compared to Web3. And thinking how in traditional venture, when there's a founder that starts a new project, they get VC funding. And generally the incentives are super aligned. Like, everyone wants the project to be successful. If it's successful, like both founders and early investors, they make a lot of money. If the project is not successful, they don't make money at all. So the correlation between success and making money from it is very strongly correlated. And I think that aligns incentives quite a lot. But in Web3, we don't get that correlation anywhere near what happens in traditional venture. We often see projects that launch at a very high valuation. They quickly go to zero, but allows for certain market participants to make a lot of money. So that correlation is very weak. And I think that creates the wrong incentives because those market participants they're not prioritizing the long-term success of the project. There are other things that are important in the process. And I think that creates really dangerous incentives. And there's this famous quote from Charlie Munger about, okay, show me the incentives and I'll show you the outcome. And I think here in Web3 is a good example of how having the wrong incentives is having an influence on the outcomes that we're having and the type of behaviors we sometimes see in the industry. So I think it's been like a super interesting like rabbit hole to look into it. And I think generally people agree on the problem, but then the way to tackle it is where it gets more controversial. There's different opinions, and I think it's like super interesting topic to look into it.
Yeah, for sure. I guess with that said, why do you think it exists first and foremost? Obviously, between me and you, the incentives are clear, right? If someone can make money without necessarily having to put in the hundreds of hours, the years of creating a successful project, but they can still get the results of having a successful project, it makes sense. But why are they able to do that in crypto specifically? Like, why is there a difference between traditional venture and early stage crypto in that respect?
I think the main reason is the lack of regulation, which being in a permissionless industry is great, allows for like many great things to happen, but also has some downsides. And I think certain value extractive behaviors and short-term oriented behaviors in crypto are just not possible in traditional venture. You get a fine, which is not possible at all. But in crypto, it can happen. And therefore, there's a few things I think to keep in mind is the fact that there's no transparency means that accountability becomes much more difficult, because if someone extracts value in the short term and doesn't get punished for it, then it's more likely to do it again and again. So that's why I started thinking about a bit of the prisoner's dilemma applied to crypto. And I think it's just like, I think the quick way of explaining it is when you think about, okay, how a market participant behaves. Do they want to be like long-term oriented and not extract value, or do they want to be short-term oriented and extract value? And in an ideal world where everyone wants to be long-term oriented, be nice to each other, then that would probably allow for the industry to grow, better use cases, like solve real-world problems. But the problem is that that's not the case, because very frequently market participants are better off by just extracting value in the short term, because there's no guarantee that other people are going to be long-term oriented. And if you're not sure what other people are going to do, probably the rational thing to do is just to extract value, because in many cases they are private entities that they need to make money, and the way to make money is sometimes by extracting value. And yeah, that creates like the wrong incentive. And if they are not being punished for it because there's no accountability because of the lack of transparency, it creates very tricky dynamics. And I think the part that worries me the most is the impact that those behaviors can have in the industry in the long term. Because if we don't prioritize building good products, be long-term oriented, and people just want to extract value, then yeah, what's going to happen with the industry in the long term? Like, how much is it going to grow? Is it going to damage the potential of the industry? So that's why I mentioned the tragedy of the commons. That is, when this prisoner's dilemma keeps happening again and again, and people just try to optimize for their own profit, then it has the potential to affect like the long term.
Yeah. And this is where you would get into like a circle of projects coming up with a crazy idea, raising venture funding, and basically spending a ton of money on marketing and hype and building this crazy story, launching a token when realistically they might not even be on mainnet, or there's no product, there's no success there. Founders get rich because the token launches at high FTV. Investors get rich because it launches at high FTV. Market makers are making money because they got some deal to market make the token at TGE. Exchanges might have got paid for the listings. Like everyone's making money. And it seems to me like, yeah, one of the main things, which might be so obvious that it's not worth mentioning, but it's just the fact that because of the creation of this new asset class being tokens, and the fact that they're liquid so early, that seems like this kind of the source of the incentive misalignment thing. Whereas like traditional venture, you might have to wait 10 years for the liquidity event, even longer. There might not be a liquidity event, whereas here the liquidity event might be happening like 1-2 years in.
Totally agree. And I think that's why it ties to the lack of regulation element, that in traditional venture, if you want to IPO, you need to meet certain milestones, and by the time it's liquid, there's certain guarantees that the project has reached certain level of maturity. But in crypto, that obviously doesn't happen. You can launch a token whenever you want, has some pros and cons. But I think in the context of the incentives that it creates, it's quite dangerous. So yeah, totally agree. And I think what you mentioned, like it's very clear kind of the market participants that can benefit from it. Then when you think about the ones that are mainly affected, are often retail participants or people who are generally like long-term oriented. And the tricky part is that sometimes they don't care or are worried about being in that position, because sometimes new retail participants that get into the market in this cycle, for example, maybe they want to speculate on chain, trade meme coins, do 100x. So I don't think maybe they're not aware of this incentive misalignment or the information asymmetries that there are in the industry. But yeah, I don't think there's enough concerns about this issue. And the reason for me to write the article was calling it out and try to drag some attention into it, because I think it's an important one.
Yeah, and you could almost argue that the people who are benefiting from it might be benefiting from it in the short term, but in the long term, it's kind of like an Ouroboros, right? Because it's like, if you continue to do this again and again and again, then potentially the industry shrinks because less people are interested in it from an outside perspective. And it kind of just like this self-referential, like eating itself because of this short-term incentive misalignment problem where people are kind of just rushing to capitalize as quickly as possible without building anything of long-term value.
And that's super tricky situation, because who is going to be the one changing those dynamics? Like, if they are making more money from these value extractive behaviors, I think centralized exchanges are a great example that they could prioritize protecting their customers, only listing tokens that are legit projects at reasonable valuations. But in general, it doesn't seem that they've been doing that for the last few years. And they've been prioritizing different type of assets being listed. So yeah, I think it requires key market participants to change their behavior, but yeah, they're not incentivized to do it. And again, going back to the point of transparency as well, they're not incentivized to increase the level of transparency. And if there's no transparency, it's very difficult to have accountability. And if there's no accountability, they can keep doing the same and again and again. So yeah, it's a tricky situation where I think the problem is very clear, but it's not that clear how to tackle it.
Yeah, that makes sense. Yeah, I would say that anyone who's been in crypto long enough to develop the kind of cynical side, which takes a while to get to, because when you first get into crypto, it's like pure optimism, right? This is a new thing and it's this new asset class, and you've Bitcoin, there's all these new concepts and pure optimism. And then over time you start to realize, okay, like there are problems and there are things which could be worked on. So I would say it's, like you said, it's pretty much clear to most people in the industry that this is a problem. But like you said, the solution to it is less clear. And you lay a few things out in the article in terms of what could be the solution. You've already mentioned a couple of them being transparency and accountability. What do you think that looks like in practice for the different counterparties? Is it an investor thing of investors and team being like more disclosures in terms of the tokens they hold, when they're selling, etc.? Is it an exchange thing? Like, what does that look like in practice, do you think?
Yeah, for sure. I can cover a bit of like the different approaches that I think, like when talking to other people in the industry, what some people think about how to tackle the issue, because I think some people argue that relying on regulations could be the best approach. Other people think that doing nothing and self-regulating would be fine. And I think my point was a bit more on like the self-regulation, trying to push for transparency and accountability is the probably best approach. I think the challenge with hoping for regulations to come is that there's a couple of issues, I think. Like one is, in a global industry, it's very difficult to regulate it. Even if the US changes the regulations, there's going to be other countries that can allow for different things. So that's very difficult regulations by itself to fix the problem. Also, regulations not always are going to be beneficial for the industry. And I think we've seen examples of recent regulations that have been probably not well-intentioned to help the industry. So I don't think regulations only are going to help, although it would be nice if we had them. And then doing nothing and just wait for the problem to self-correct. What I mentioned before, because there's no transparency, there's no accountability. It's very difficult for the problem to self-correct if people are not aware of the problem. They don't see that some market participants are extracting value, doing shady stuff. So if those things are not public, it's very difficult to self-correct. So that's where I ended up with the conclusion that, okay, we probably need to self-regulate and requires people to be a bit more proactive, call out the issue, and try to incentivize the right behaviors. And yeah, it's a tricky one because I think it would require from, first of all, people agreeing that the problem exists. Then, yeah, starting calling out bad behaviors, requesting for more transparency. And I think that applies to VCs, founders, exchanges, like market makers. I think everyone should become more transparent, but that has to come from the community and people in the industry asking for it. And I think with exchange listing has been a good example of people have been very vocal complaining about some of the dynamics have been with low float, high DV, tokens launching at a very high valuation, and that seems to be slowly changing. But I think there's much more that needs to be done. So I think if people push for it and make it an important issue, then it's more likely to change. So I think it requires like push from the community.
Yeah, my naive take on it would be, we're already seeing some signs of nature is healing in some respects. When you look at some of the high FDV launches end up trading below last round, or they get punished very hard on listing at too high valuations. We've seen this quite a few times with a lot of the ZK L2s, which just for some reason seem to think that they could launch at crazy valuations, and there was just no bid. But it seems like whoever was the buyer for tokens in that category, maybe in the last cycle or in 2017, are slowly disappearing. Like they've maybe been burned one too many times. They bought that new shiny coin at high valuation one too many times, and now maybe they're just sticking to majors. Maybe they're buying memes. It seems like they might be buying memes because I guess they feel safer. It's like, okay, there's no team or investors like publicly who are going to dump on me, even though there are often like clusters of insiders. So yeah, what would you say to that? Like the market is already trending towards a healing process. Would you agree with that? you think we need more?
I agree to some extent. So it's true that the high FDB launches is a good example of how people realized that something was wrong. It was called out, and then it's been like every time I think retail understands more the issue. They've been less active participating in those type of trades. But the problem that, okay, probably most of the activity has transitioned to memes, which are not that different to the high FDB in my opinion. Like I think many of these token launches are like heavily controlled by insiders, like the corner 80-90% of the supply. So it's a bit of like replicating the high FDB, but just with different type of insiders. And then the argument of being like, okay, there's fair tokens, like there's no insiders there. I don't think that's true in many situations. So I think rather than fixing the problem, we've moved from one problem to a different one. So I think it's a good example of how the community can identify a problem and try to self-correct it. But I don't think we're moving in the right direction because we've ended up in a different problem with different reasons, but still not the right direction probably.
Yeah, maybe even less transparency in some cases, because someone could in theory snipe portions of supply close to launch if they're an insider, and it's potentially even worse than having, at least with some of the VC coins, quote unquote VC coins, you can see the token distribution. You might not be happy with it, and they might dump OTC, but at least you know where it started. Whereas some of the memes, it's like you literally just, you can see the clusters on bubble maps, but you don't know who they belong to. You don't really know what's going on. So yeah, it's difficult. And I suppose if VCs are able to still make money on average, even if some coins end up launching and trading below, if they're making money on average, they still continue to fund those projects equally.
I totally agree. And I think that's a great point. I think even though we've moved from one problem to another, at least in venture markets, probably VCs are being more careful how they allocate funds. Probably the late stage Series A, B that were going at super high valuations a couple of years ago, those are not happening that frequently. So I think, yeah, it's having a positive impact on early stage markets, but attention moving towards meme coins, I'm unsure how like those things are going to end up playing out. And once the hype phase of like starts to slow down, I'm a bit
So if we take that and we say, okay, self-regulation is probably like the best thing. If you've got the market healing over here, but it's uncertain, maybe it doesn't happen, and maybe you end up with something worse. And then over here you've got regulation, and it's in the hands of someone outside of the industry who might come with a heavy hand or not really understand exactly the problem in question. So what do you think self-regulation looks like? Is it a question, like we already mentioned, transparency and accountability is ideal? Is there something that can be done as well in terms of the actual structure of how this incentive misalignment came into place, which is obviously early liquidity? Does something need to be done there in terms of be it vesting, token design, these type of things?
I think token design and token vesting is one of the key areas that probably should change, and I think it's going to change in the next years. And I think there's been a lot of debates about what's better, like longer vesting, shorter vesting. Now the standard probably 2 or 3 year linear vesting. I think in general, no one really likes that design, but became the standard. I think a lot of people have argued for like just short vesting, unlock most of it on day one. I'm more on the camp of longer vesting, but I think over time I've changed my mind a bit. At the beginning, I thought just longer linear vesting would be better. I think then over time I became more positive towards having some form of like a KPI-based unlock. I think in my opinion, the reason why I don't like short vesting, I think it doesn't fix the incentive misalignment problem. And something we haven't mentioned yet, but I covered in the article the logarithmic utility of wealth and the idea that as wealth increases, the marginal utility decreases in a non-linear way. So for many people, they're going to be happy to just exit for like a decent amount of money and create very dangerous incentive of not being like long-term oriented in a project. So let's say if a founder owns a decent percentage of the supply and is trading at a very high valuation, they're probably going to be happy to take like a 80-90% discount OTC, just make a few million. That's probably going to allow them to retire. And yeah, it's very difficult to incentivize founders to be very long-term oriented. Same for VCs as well, to be like long-term oriented. And yeah, I think having a very short vesting potentially can incentivize those short-term value extractive behaviors, because many people argue that, okay, if a token was meant to launch at 2 billion, 3 billion, if you fully unlock it on day one, maybe it's going to trade at 500 million instead. But still, if you're a founder or a VC that wants to extract value in the short term, at that valuation, you can still extract value. You can do a KOL round to create some hype before the launch, try to pump the token a bit and exit quite early. So yeah, you're not going to exit it at 2 or 3 billion. Maybe you do it at a lower valuation, but probably what you can extract from there is going to be high enough to create the wrong incentive. So I think short vesting doesn't really work. Also, it's probably not a solution because up until now it hasn't been possible in the US. So it's not even a realistic approach. Then long-term vesting, if it's linear, also can create wrong incentives. I think something that people sometimes mix is the idea of having long-term vesting with low float, high FTV. It's okay, if you have very long vesting, it's going to be low float. You don't have fair price discovery. I disagree with that. I think you can have long vesting and high float on day one because still it's fine that insiders are locked. Like team and BCs can be locked for a long time, but you can still get other parts of the supply out fairly early. So I think if you get out 40% of the supply early, it's fine that the insiders are locked for a long time. So I think that's not an issue. And I think people kind of combine the two ideas very frequently. I don't think that's correct. But then when I started thinking more about KPI-based unlocks, I think that's when it clicked for me and I realized, okay, that's potentially better than a long-term vest because, yeah, I think it creates much better incentives. And I think in the article, I mentioned the example of an L2, how they could design their token vesting based on KPIs. And I think one of the common concerns with KPI unlocks is that it could be manipulated quite easily. If you do it based on fees or you do it based on TBL, can be manipulated, then you unlock it and that's it. So you need to be very careful with the metrics that you choose. And I think that has to be a combination of different elements. So in the context of an L2, one part could be valuation using like a moving average. So let's say for each 1 billion that you reach in valuation, using a 3-month rolling average, for example, you unlock 1% of the supply or 2% of the supply. So yeah, it's very difficult. You can't just like pump it for like a day and then
it needs to be sustainably growing and accruing value over time in order for that to be true. Yeah, exactly. It can't be the pumpermentals.
Exactly.
They're paying some KOLs and then pumping it because.
Exactly, yeah. And then I think there's other elements you can introduce. There's things like shipping the product, like in the context of L2s, could be reaching stage 2, decentralize the sequencer, things that are in the roadmap and they're meant to do. Because I don't think it should be 100% based on the performance. Like I think if you're well-intentioned as a founder, you build a product and you deliver what you promised you were going to do, it's fair to unlock some tokens, even though maybe that doesn't get any traction. So I don't think it should be 100% based on the pure performance. So yeah, combination of valuation, delivery, like shipping the product, could be things like TBL, attracting applications, the performance. If you promise you're going to reach certain like TPS or having like uptime, so you can combine different metrics that align with the long-term success of the project. And yeah, I think if you think from the perspective of a liquid investor or also even venture investor, if the founder tells you, okay, I don't want to unlock any token unless my project reaches certain valuation, that's really bullish because it's a way to show conviction in what you're building and aligning incentives very strongly compared to others. Okay, I want to unlock everything in 3 months. So I think it's a good way to signal conviction and incentive alignment to the rest of the market. And I think it would be interesting to see more experimentation on that area. I don't have a strong opinion on exactly how those percentages should look like. I don't know if like in the article I suggested 80% KPI based, 20% linear vesting, because some people argue that it's, having some unlocks for the founders are good. Like I think Jordi mentioned that it's not good if a founder has 10K in the bank and then 50 million in like locked tokens. Like that's not great, I think, and like can create the wrong incentives. So I think it's fair that insiders can unlock a little bit, but you need to keep in mind the logarithmic utility of wealth. Yeah. And if they unlock too much in the early days, can create the wrong incentives. So yeah, it's trying to find the balance between the two.
Because you can't expect every founder to be like Zuckerberg or Musk, who's just gonna, no matter how much money they have, they're just gonna continue building and then just forever. Mm-hmm. Like the logarithmic utility of wealth is real. Like you see it. There's loads of empirical examples. I'm not gonna name drop projects or tokens who sell OTC, but like there's a lot of it happening. So clearly people are willing to potentially jeopardize the future of their project to make, be it a few $1 million up to, you know, tens of millions of dollars. Like it's very real. It happens all the time. And I guess probably the reason why people would argue for the short vesting is potentially because for a retail or liquid participant, it looks better. on paper, it's like, okay, like all the supply's out, we can let it find a fair market value quicker. But for the long term of the project, for the reasons you stated, it probably isn't the best thing. So the KPI thing is interesting, and it's not necessarily something which I have heard anyone speaking about, nor have I seen it in any docs or any tokenomics like ever at all. It's always just like a deterministic thing of like, okay, like this is the supply at launch, that's the best thing, whether you like it or not, that's how it is. Like it's been decided. I think that's really, really interesting. But the key would be to define what are the right metrics. Maybe like VC backed applications launching on the chain would be potentially like an interesting thing, because it can't be just like forks. You know, the team could make their own forks and launch them. So definitely controlling the metrics will be key.
I think we need just more experimentation on that area. And I think something also that is worth exploring is potentially teams having a bigger allocation of the token supply if they choose to have this type of token vesting, because this idea of having convex payouts as well is that, okay, if the project is not successful, then they're not going to get like a big payout. But if the project becomes successful and you reach those milestones, they deserve a big payout. And I think at the moment, the percentage of the supply that they get is not that big. And I think that makes sense for Bitcoin, Ethereum. You want like a very decentralized distribution of the supply. But for a decentralized application, I think it's fine if founders get a bigger percentage of allocation. They are more incentivized to be long-term oriented. So I think that's something that should be explored. So they are taking the extra risk of not having the linear unlock. But then if things go well, they can get this big payout. So I think that would help as well.
Yeah, makes sense. So I guess, what do you think the implications are for the industry? We discussed it a little bit. If we're not able to solve this problem, what's going to happen?
It's a bit worrying. It's hard to tell because I think the industry has been making good progress despite this incentive misalignment problem. But I think the best case is just slowing down the adoption of the industry. And some people argue that the adoption of the industry is going to happen regardless of anything. It's just going to happen one way or the other. I think the risk is that if that's not correct, it just might not happen. And if we keep misallocating capital in like early stage, founders are focusing on the wrong areas, and there is the risk of like not reaching the potential in the industry have. And I think in the last few months, for example, there's been these conversations of like, with all the hype with meme coins, is the industry just going to become a casino where people just use it to speculate, or there's a potential to create more solving real world problems, like having better applications. And I think there's the potential that the industry kind of diverges a bit, and there's in developed countries, we have more like the speculation part, and then emerging markets, they go more towards stable coins and more like clear use cases. Maybe we start to see that differentiation a bit more. I don't know. I think the worrying part is that it's very difficult to tell what the outcome is going to be, but I think it would be much more likely that we have a better outcome if we have the right incentives in place. So
yeah, for sure. And we're already seeing, well, some self-correction in terms of the way things are trading, and also maybe retail participating less in these type of launches. And then also the emergence of projects which seem to be able to achieve quite significant success without necessarily raising venture funding as well. Obviously, this depends a little bit on the team in question and their ability to bootstrap. But Hyperliquid being an example where I think with 8 or 9 people, they've done what they've done, and it's okay. Yeah, the team comes from a market making background, probably had some funds themselves personally. They're able to market make on the exchange in the early days, most likely, and generate some revenue from that. So there was a source of funding, but still, to me, it's not necessarily clear that you necessarily need the amount of funding which a lot of these venture capital funded crypto companies necessarily have, because it's not like then a lot of them are necessarily building no physical infrastructure there. A lot of it is just developer hours. I don't know what you would have to say on that.
I think there's a big misallocation of capital in venture, and there's a lot of capital that has to be deployed. And I think something we see often is that when there's a project that is successful in a new vertical, then we see many copies of the same project, because many VCs don't have exposure to that vertical and then want to get some exposure with other maybe like low quality projects. And like there's a lot of capital that has to be deployed, sometimes not enough good projects to do it. And I think, again, thinking about the dynamics with investing early stage, some funds might prioritize to get a high markup post-TG because they need to raise for another fund. Not everyone is prioritizing for the long success. long-term success of the project. So yeah, I think having the wrong incentives in venture creates also some issues in the actual products that get built as well. So yeah, I think Hyperliquid has been a great example, and I'm very curious to see what they choose to do with the token design, because they might be able to experiment a bit more with the.
And it's very much, we're waiting to see. I thought we were going to see something a little bit sooner, but let's wait and see. I think that team in specific, if I was a venture capital, if I was working in VC, or if I was a founder, for example, who'd taken VC funding, that would be quite a big, like, wow, they actually did that without necessarily doing all the things which the majority of teams do. So interesting example for sure. How is this impacting you personally, I suppose, and Peridon as well? Because obviously you mentioned at the start, but just to reiterate, Peridon is not necessarily a fund which needs to, pump up the marks to raise another fund. So you can kind of take a longer term view generally. How are you seeing this impact the actual private market and the VC landscape? You mentioned it's moving slightly earlier stage. What are you seeing there?
For us, the way how we try to approach it is just being long-term oriented. Like we're not in a rush to deploy. We're fine waiting if we don't see any project that we have very high conviction. But when we find a project we like, we just try to align with incentives with them, support them, being proactive. And yeah, for us, in general, try to focus in the long term, because what I mentioned, like for us, we don't need to fight with other VCs for like this kind of super hype rounds and like trying to have high markups in some projects. So I think we're playing a bit like different type of game for us. And I think being long-term oriented probably helps with, focusing on areas that we think are going to be like going to grow in long term. And yeah, I think for like working in that type of fund is much more enjoyable than others would be, I think.
Yeah, you don't necessarily have to play the game that other people are playing. You can just say, oh, this founder, we're not quite sure about his actual, what's actually going on. You can pass. It's not a problem. They're not forced to deploy.
Exactly, yeah. And that's the thing. Like not being in a rush to deploy helps to just be more selective and just find the projects that you have very high conviction and you're committed to work with them for like many years. So.
It seems harder potentially for public market investors because they don't necessarily have, you speak to the teams, you're able to get a feeling of the founder, but public market investor on average doesn't have necessarily great information, which I guess is why we're seeing what we're seeing. But how do you think it's going to play out in public markets if you had to speculate and imagine what the implications are?
We're starting to see what we mentioned before about the self-correction with token launches, and now those tokens not launching at a very high valuation anymore. And I think hopefully it's going to become better also for liquid market participants, because they're going to hopefully be able to buy tokens and not so high valuations and have better opportunities. I think there's also a big misallocation of capital between venture and liquid markets, and much more money has gone to venture funds. To some extent, I can see why, because I think the performance of venture funds has been better in the previous years compared to liquid. But then, for the industry, I think to grow, it requires liquid funds being able to buy as well in liquid markets. I think the challenge that we've seen is that many projects don't justify the valuations that they have by the time that they launch. So it's very difficult for liquid markets to buy those tokens, hold them with long-term conviction, because many of them don't justify the valuation. So often it's just like short-term trades. So it becomes challenging, but over time, hopefully those dynamics correct.
Yeah, that's definitely, as a secondary market participant, first and foremost, that's exactly how my experience of it is that basically the slow realization, pretty much everything is a trade. It's like almost impossible to find something which you would actually feel comfortable investing in and just not watching price. It really is just the majors, and even within the majors, it's like, okay, like Solana versus Ethereum, there's questions there. So like, do you actually reach the point where the only long-term investable asset is Bitcoin? That's the question that I sometimes ask myself, is like, is everything just a trade?
And I think it's important also to benchmark everyone's performance against Bitcoin, because if anyone is taking additional risk for having like other assets but are underperforming BTC, just like not worth it at all. So I think that's important.
Yeah, for sure. And that's something I preach, is like everything should be benchmarked versus Bitcoin. Because if you're spending all this time, human capital, resources, etc., and you're underperforming Bitcoin, like it's probably not. Probably should back it up.
Exactly. 100% agree. Yeah.
Perfect. Yeah. So I mean, with that said, I think we've covered pretty much everything that we wanted to cover today. Obviously, if you're watching this, definitely check out the article itself. There's a lot more in there in terms of what these for example, the token design could actually look like in practice. So yeah, with that said, thank you for joining. I've personally enjoyed the conversation. There's a lot of open questions there. We'll have to see how the industry develops over the next few years and see who actually comes forward to solve these problems as well. So yeah, thank you for joining, and hopefully see you again soon.
Thank you for having me. That's been fun. Yeah. Thank you. Thank you.